Hello, everyone. Matt McCleary back again. Welcome to our second session of the day, which is credit markets. Secured debt is really sort of the oxygen that makes this business work. It's really the key form of capital that allows owners to buy ships. It allows equity to get a return, and it's just in a remarkably well-functioning market. Like everything else, though, the shipping finance business is changing along with changes in the world and the larger capital markets. And we were really excited to convene this panel today to kind of take stock of where the credit markets for shipping are. And so I want to turn it over to Mike Timpone to lead the discussion. We're thrilled to have the group with us today. Paul Taylor, obviously with Societe Generale, which is a large bank. We have Frit dialing in from Macquarie, which I would say was a medium-sized bank, and Elias with Australis. I don't want to say a small bank, actually not a bank at all, a direct lender, who represents yet another part of the market. So I think the hope is to come away with a sense of kind of market conditions and what to expect in the year ahead. Mike is known to many of you. He's a partner at Stewart & Kissel, which is extraordinarily active in the transactional market for ship finance, both capital markets and all forms of credit. So with that, thanks again for being with us. Mike, I'll turn it over to you.
All right, thanks very much, Matt, and thanks everybody for joining. I will say that I'm glad we're able to do this. Welcome you to my 12 by 12 home office that I've been stuck in now for about 10 months. I also now feel terrible for all of you for having to now I have to look at myself on the monitor, so I know what you're looking at. Apologies. Welcome to what I hope is the last remote Marine Money November session in New York. I much look forward to getting to see all of you again in person. But I do very much thank Matt, Mike, and Jim for getting us all together virtually, because it's great to keep in touch. As Matt said, this is credit market conditions for ship finance, the $150 billion question. I'm joined by Frit Wilhelmsen from Macquarie Bank, Elias Sakalis from Australis Maritime, and Paul Taylor from PacGen. I'm not going to try to say it eloquently as Matt did. I don't know, gents, I think we'll just dive right into it rather than use other for introductions. So if you don't mind, Elias, I'll start with you. One of the questions we had on our agenda here was what deals are bankable now? And as we all know, direct lending has been increasing here. In fact, we used to call it alternative sources of finance. Now we call it direct lending. So that shows a change in the market. But I guess my question to you is, do you think direct lending will continue to increase in shipping? And where do you think we'll be in 5 years?
Thank you, Mike. This is obviously a very good question. We would make a couple of observations from our perspective. Direct lending is relatively new to shipping as an industry, but it's a form of financing that has been around for decades, starting from the leverage market for SMEs in the US and moving on to other asset classes. That's point one. So from that perspective, it's nothing new, and it's not a new form of lending. From a shipping perspective, it's also interesting because if you looked at shipping as a $1 trillion asset class a decade ago, it would have struck you that the sources of financing were tremendously concentrated to private ship owner equity and to bank lending. And for an asset class of this size, this is unprecedented. If you look at other asset classes like real estate, like infrastructure, the financing sources are probably a decade ahead of shipping in terms of diversifying into direct lending, into capital markets, into other forms of financing. And this is very, very likely to happen to shipping as well. So yes, we definitely think that direct lending will increase its share of the overall pie in terms of financing, but it will not be the only new form of financing for shipping, and new forms will also evolve as well.
Thanks. Paul, if I can follow up on that, where do you see, obviously sitting at, large banks, and having been involved in shipping and offshore for quite some time, you've seen a lot of changes. Where do you see the market in 5 years, and how are you going to work with the new sources of debt and equity that come into the market, be that alternative finance, or direct lending, or whatever else comes next?
Yeah, thanks, Mike. Hi, everybody. Look, shipping, we're in this new sort of paradigm that has hit the market. There's a new approach to risk management that we haven't seen before. Technological risk is higher than ever before, obsolescence risk in shipping. We've also got regulatory issues to look at, ESG issues. So the list of challenges for us all is pretty, it's important. It's a major challenge to us in the sector. So we really have to look at where we all want to be. We have to all ask ourselves the questions: where do we as a lender want to be in this sector in order to actually make a profit? So we do see significant changes moving forwards over the next 5 years. I think those banks which have purely made lending being a passive lender or having the herd mentality in this sector are going to probably struggle going forwards as all these new challenges come at the same time. What we need to do as banks, I feel, is to have more strings to our bow. We need to offer more than just plain senior debt as the margins either increase or we start losing money. We have a wider offering to our client base, whether it's advisory, M&A, capital markets, leasing, export finance, all of those, some of those. We need to decide where we want to be in the market. And those banks which actually are able to embrace that and also look at the ESG side of the equation, I think have a really healthy role to play. In the next 5 years, there'll be very good opportunities to partner our clients. But let's not forget that over the next 5, 10, 15 years, our clients are probably going to need us, the banks, more than ever before as they try to face this energy transition. So there's certainly room for senior debt banks, but to work very, very closely with all sources of finance across the capital structure, including mezzanine, equity. We'll bring capital markets into that as well alongside the bank. So we all have a key role to play, but I think we all have to ask ourselves as banks and as other financiers, what is it that we're trying to achieve out of this, and how do we add value, and how do we make money?
Thank you. Fred, that's a nice segue into my question for you. As banks are analyzing and trying to figure out if they still want to be involved in shipping and energy generally, and the consequences that are associated with that, I assume that's something that Macquarie is looking at, and I'd be interested in the bank's take and your take on whether or not Macquarie sees shipping and energy as a long-term space they want to play in, as we've seen other folks exit kind of more frequently than enter lately.
Thanks, Mike, and thanks for inviting me to the panel today. If I go if I'm not clear, can you let me know, because sometimes you guys are a bit patchy for me. I don't know if it's me or the audio or just the general settings. Well, yeah, thank you very much. So as you said, yeah, we're as you alluded to, we're a fairly new entrant to the lending market in shipping. Macquarie has a huge presence in infrastructure, energy, whether it's renewable or fossil fuel related energy. And shipping was a space which we all know, it's no secret, it was undergoing quite a bit of dislocation. Still is to some extent 4 or 5 years ago from a capital standpoint. So there was room for a new lender to come in and, as Paul alluded to find their identity, find their reason for being in the space, long-term, medium-term, for profit-making purposes, for whatever purposes. And I think we've struck a nice balance here. Has now got a 3-4 year track record lending in the space. Macquarie's balance sheet, bilateral lending. We think it's still a very good time to be a lender in the space. The valuation point is in the cycle, or there've been many cycles over the last 4 years, but the valuation entry point is good for a lender. Many of the segments that we have been financing, which are basically bulkers, containers, and tankers, have had their ups and downs in the last 4 years, but we've been focused on asset finance structures, making sure that the market can sustain the debt service that we extend. And so what do we think about the long term? I think we're for sure here to stay as long as we can be relevant and as long as we can make the returns work for us. Today, I'd say it's going really well. We have lots of challenges to look at as a lender, not just counterparty risk and credit risk, but regulatory risk, technological risk, everything that we've heard about in the previous panel and what we will probably be talking about now as well. But I think Macquarie, we will be in this business for as long as it makes sense. And right now we're sitting pretty. We've had a good ride through COVID, where the portfolio has not been affected, and we're growing. And I think I would echo what Elias said earlier, is that there is lots of capital available for shipping. There are lots of sources, and probably more than there ever have been in shipping. So it may be more expensive, it may be stricter, but I think it's generally quite an exciting time, and we'll see a lot of evolution of that capital mix in the next 5 years as ESG becomes a bigger theme. Probably you'll see more pension funds, etc., coming into the space. We're already seeing it. So yeah, definitely an interesting few years to come.
Thank you. Yeah, I can say from my perspective, 20 years ago, the source of capital was bank loans, and we've seen a lot of changes over that 20 years. I appreciate that insight. Paul, as we talk about change, and as evidenced by the fact that we're doing this remotely, a lot has changed in the last 12 months, and hopefully we'll get back to what we're all used to sooner rather than later. But we've seen a lot of businesses destroyed, from the mom and pop shop restaurant around the corner to some larger companies that are just struggling through. But a lot of companies have really benefited from this. Technology companies, for instance. How has your business changed, and how the terms of the deals that you're willing to do, how have they changed? Have they been impacted by this?
Look, I wouldn't say our business has changed dramatically. I've been pleasantly surprised by the resilience of the shipping sector as a whole throughout COVID-19, and this is tremendous. We haven't seen any defaults in our portfolio, which is not what I expected maybe at the outset. But clearly, it's not just COVID-19, as I mentioned just now. We've got a pile of other challenges here to face. So when we look at our business, it's not just in sort of a reactiveness to the environment we face today with COVID-19. It's everything else that's been in place for the last few years. So we're not looking at any sudden change in our business. We're evolving slowly, and as I mentioned, we've got to evolve through various businesses, have several different client offerings, and that's something which we will continue to do, and I think it's the right way for us. That said, looking at more the lending side, what we're probably seeing at the moment is that across the market, we're seeing more corporate-based transactions, and it's something which we're going to follow this as well. We're going to be much more client-driven. We haven't been looking for new clients through the last 9-10 months particularly. It's not to say that we wouldn't accept a new client, but we've been there for our existing clients to tide them over what has been an incredibly difficult period. So the transactions which we're looking at the moment, and probably going forward, will be more corporate-based. I think we need to be adaptable and agile towards our client needs. So we're seeing more transactions that our clients need from a balance sheet perspective. We're seeing greater financial covenants coming into play to reflect the fact that more corporate transactions and asset finance deals going forwards, or certainly at the sort of top end tier of the market which we're in. We're also seeing much more liquidity available for these better transactions, and that's something which, you know, it leads to inevitable competition in this space, but that's fine. No, we're used to that. So our strategy will be to continue to work very closely with our clients on corporate and on project transactions. We're going to have to accept there's going to be more competition going forwards than maybe there has been in the past, but that is just the way ahead. There's probably going to be less competition in the lower space, but it's not an area which really Société Générale have placed ourselves in. That's proven to be a good business model, a winning business model for us, but that's not to say, of course, that it's right for everyone else.
Thank you. To that point, Elias, Britt, does that present an opportunity for your entities to perhaps make those loans that wouldn't be the corporate credits that were appealing to SocGen?
Yeah, for sure, absolutely. And it's, if you like, it's part of the core thesis of any direct lender. And the first sign of direct lending going into any industry is when the senior banks, for whatever reason, are changing their focus. That can be economic reasons, that can be regulatory reasons, et cetera, et cetera. For us, the math is very simple. 60% of the global fleet is controlled by owners who own less than 20 vessels. As Paul and the established larger banks are focusing more on the corporate side of and to simplify the larger clients, it leaves a very, very big tail of the market with lack of access to financing. So that is certainly one opportunity. The other opportunity that's been created is from a regulatory perspective, in that, generally speaking, in our experience, it might not be the case with Société Générale, it might not be the case with Macquarie, but in our experience, there is also a different set of internal, if you like, policies that certain more traditional lenders are imposing on themselves voluntarily, not to lend to vessels which are older than X years old, not to lend to particular segments in the market which are perhaps more exposed to environmental challenges, et cetera, et cetera. From a direct lending perspective, we wouldn't put ourselves subject to such constraints, and therefore that probably would create additional opportunities for us.
Thanks. Chris?
I think that I echo what Elias said. We are coming at this from, we have a different target market to, for example, SocGen. There may be some overlap from time to time, of course, insofar as it may concern, for example, older ships, older than 12 years old, if SocGen doesn't want to finance that age type of vessel. So yeah, I think I agree with everything Elias said. It does create an opportunity for new entrants. The fact that the largest Western and to some extent, I guess, Chinese lessors, so Western banks and Chinese lessors have been focusing on the top tier, whether it's private or publicly listed. It creates an opportunity for us, and that's just the way any market would work, I guess. Where we try to, and we have to acknowledge that and realize that competition is actually pretty extensive at any capital source, really, in the shipping sector. There's always going to be, for example, our activity levels in Greece have been somewhat curtailed this year because the Greek banks have been enormously supportive of their domestic ship owner base. And regionally, you have pockets of liquidity popping up among banks here and there. We cover the world in all modesty from our office in Europe. So we play around different geographies, and we see these trends sort of popping up. So you have to sort of as a new entrant that's looking to be opportunistic and not, you can't rely on necessarily a decade worth of client history. You have to be opportunistic with geography, vessel age, the situation itself, recourse, non-recourse, and that's kind of what we're aiming to do through a bank lens as opposed to a fund lens.
Yeah, I guess the moral of the story is, I think, as Paul said and Elias said, there's room for everybody. Very capital intensive and different different owners are appealing to different sources of capital. Elias, the global central banks have cut rates to 0 or below in some instances. You know, we know in the States anyway that that's going to continue. You know, and sending some stock markets while they may be they may seem bipolar depending upon the day, but generally sending the stock market all kinds of new highs over here anyway. Can you talk about whether or not, you know, the accommodative policies of cutting interest rates to 0 has impacted your business, assuming you're not taking deposits, of course? And
yeah. Look, it has for sure, and it has done so in a couple of different ways. Clearly, from an end demand perspective, an accommodative stance is positive, especially when we're going through a year like the one that we're going through. And there's no doubt that for an industry which is overall so much linked to global GDP and industrial production and consumer spending, this accommodative stance is tremendously beneficial. From a supply perspective, interestingly enough, one would argue that it's terrible because cheap money would probably spur people to order new vessels. Good news, of course, in this industry is that it's not happening for the first time in a very long while, for reasons that I'm sure we're going to expand on later, both in terms of perhaps restricted availability of capital, notwithstanding what we just said at the beginning of the session, but more importantly, uncertainty around residual value, new propulsion technologies, environmental regulations, etc., etc. So on one hand, yes, it's very positive because it's definitely keeping the global economy humming, and obviously shipping is what facilitates that. But on the other hand, fortunately, it hasn't had the expected impact on the supply side.
thank you. These panels always seem longer when you're looking at them on the schedule, but we quickly come up to our limit. So I want to touch on some other points if we can relatively quickly. This may be for my own interest more than anything else, but let's talk about new business, which is, you know, the lifeblood of the lawyer. You know, Paul touched briefly on this, but I'd ask you guys all to kind of talk about, you know, whether or not you're looking for new clients, how you're able to do new business. Maybe this is a little tutorial for the rest of us on how to develop business in a Zoom age. But you know, it's been at least you know, from our perspective, we've seen challenges in developing people trying to develop new business, get out there, can't shake hands and kiss babies, as we say. So I'd be interested in your take on that, guys. Rick, why don't we start with you?
Sure. Hey, listen, I just spend a lot of time on the phone and on video conferences. That's where most of my day goes to. And just, you know, I think the great thing about the conference circuit is that it does facilitate, like, this is a global industry. It brings people together into hubs. And if you've been attending these, whether it's Marine Money or other conference circuits, you have over the last few years, then you'll be building a network. And I think people have just acknowledged that we just have to keep in touch, and you know, it really helps in times like this to have developed, you know, had been in existence for some time, because, for example, there are many new entrants to capital in shipping today, and we've been active for 3 years, and probably, you know, I'd say half the deals that we've done during COVID have been with customers that we already have in the books. So it's easy, you know, there's trust. It says people will rely on being able to work with you without having to necessarily meet up in person. So yeah, like, you have to just adjust and play to your strengths in a time like that. And but I think the sort of the big picture here is that, for example, for us, is one of the key sources of opportunity for us has been the German banks that have been slowly downsizing their books. There's been a wave of refinancing that still continues. That creates an opportunity for a player like us. S&P flows are obviously been limited, and they've been quite sort of they've been fluctuating depending on which segment you look at. That's, you know, been, I guess, a disappointing source of opportunity over the last 12 months. But you know, and then you've also got, for example, the few players who may have big capital markets sort of notes outstanding. You got to look to sort of the sources that you can find via the internet or filings for opportunities than constantly just meeting people in a deal room. So I think yeah, you have to get creative. You have to be busy and be in touch with the people in your network. And the other thing is if your clients can refer you on to other clients, which is what's happened, and that's just a bonus in these times.
There's certainly no substitution for getting out and seeing clients. We all wish we were going to see our clients, but again, I've been amazed by the resilience of the business. And in fact, we're going to have a very, very good year this year. I've got a fantastic team who globally who are in touch with their clients continuously. And it's not just about new business. Of course, we all want to talk about new transactions. There probably aren't as many of those as we would all like, but there are enough. A lot of them are legacy transactions from last year. So it's going to be very interesting seeing what happens next year when maybe we haven't had the benefit of 12 months of physical marketing. But what we will have had the benefit of is regular discussions with our clients, seeing what their needs are. There were some immediate needs after the first sort of, lockdown with COVID-19. Their needs have continued. So we are in constant dialogue, but it's also about other subjects. So it's not just about new transactions, but you know, personally, I've had numerous discussions across our client base on, say, the Poseidon principles, for example. What is it going to mean for the sector? What does it mean for them? What are the scores likely to be? And they're not directly new business links, but it keeps you talking, it keeps you in the picture, it's value added to the client. So we're all doing the same, I think, as lenders. We're doing our best. We have our clients in our sites. And yeah, it's not the same as actually being there. These conferences certainly help. It's great to share views. People may be getting fed up with hearing me, but you know, it's not the same. But hopefully next year at some point we'll be back out there physically.
Yeah, agreed. Look forward to it for sure. I don't know. I think we've had coffee all over the world. You know, and the contacts are great. So as we kind of close in here to the Q&A, I guess hopefully we've got a lot of ship owners out there and thinking about where their next capital source is coming from. So perhaps I'll just ask one question there. You know, obviously being in this business for a long time, we all know how cyclical it is, and you know, we know that we've got a strong container market right now, a weaker tanker market. You know, are you sector agnostic? Is there a sector that you're focused on that you will lend to, that you won't lend to? Just so the owners out there know which one of the three of you to call when this is over.
Sure. Happy to start. Look, in all honesty, we are sector agnostic. Truly, anything that flows in merchant shipping, we can finance. Our portfolio at the moment contains obviously the three key sectors of containers, bulk, and tank, but it also contains a lot of specialized tonnage, including, you know, chemical tankers, LPG tankers, MPPs, car carriers, you name it. So it's certainly a much more flexible way of financing the sector. That's for sure. And we wouldn't anticipate that changing over the next few years.
Right.
Yeah, for Macquarie, it's still very much a container, dry bulk, and tanker play. Within tankers, we've financed chemical product, and crude. We haven't ventured into gas yet, so to LPG or LNG. That's probably sort of the next step. We'll be looking for opportunities there, the right opportunities. But yeah, as Elias referred to this sort of word, specialized, and you know, that's probably where we stay away from ro-ros and ferries and the MPPs and etc. So it's pretty conventional commodity-based shipping that we're focused on.
And Paul, will wrap up with you.
We're sector agnostic, but so we cover most of the sectors: containers, tankers, a small amount of dry bulk, maybe less so than the others, LNG, and we have some ferries as well. But I think much more important than the sector is the client. It's a corporate approach. We want to be close to our client. We want to understand their strategy in the sector so that we can manage risk, manage our clients' needs. Going forwards, from an ESG perspective, not just the E, but of course the E is super important going forwards, where we will look at the emissions levels of the vessels we finance. And I did note the other gentleman's comments over looking for opportunistic financings if banks like SG say no. But we will look at the emissions, but we're also looking at the governance side, the S and the G, in fact. And what's key going forwards is transparency. And I think it's a word that maybe hasn't been top of the list within the shipping world over the decades that some of us have been in the sector. But going forwards, it's going to be massively important across the whole platform, whether it's a shipping company or a bank or anyone else providing services into the shipping sector. Governance, transparency is very, very key. So sector agnostic, but very, very focused on the corporate that we're doing business with.
Yeah. If I may add, Mike, just one last thought, and it's more about the philosophical approach to investing. Our first fundamental question is, in order for us to lend to a particular project, would we be comfortable providing equity to that project? Would we be comfortable to be the equity in this project? And if the answer is yes, then the underwrite is very, very simple. If the answer is no, it becomes very, very tricky. And for us, it's slightly easier because obviously we also run a big equity strategy where we acquire tonnage, basically, we acquire steel. So we have both of these perspectives. But this is probably the first and the last question we address in any of our internal materials.
I think that's a great and very interesting approach. You know, if you wouldn't do it directly, then perhaps you don't want to do it indirectly. And to Paul's point, you know, just from a lawyer's perspective, the transparency, the change in transparency over the last 20 plus years has been, you know, amazing. It's astonishing, and I know it'll keep getting better. And shipping, I think, you know, Frit made a comment about how, and Elias as well, about how shipping is, you know, catching up in other areas, and transparency is certainly one of them. It wasn't uncommon 20 years ago to see bearer shares, you know, in a loan, and you don't see that anymore. So we're getting there. Anyway, Matt's back on. I really appreciate your time, gentlemen, and sorry we didn't get through all of them, all the questions we talked about, but there's so much to talk about. We could probably do it all day. But Matt, back to you.
Yeah, thanks, Mike, and thanks, guys, for a great session. It's you know, Frit mentioned there are more sources of capital than ever for shipping, and I think that's definitely true. There might not be more like total capital available than ever, but there are more sources, and I think we've definitely seen a parsing of risk and structure and cost. You know, I remember when I started, it was like a kind of one size fits all business. It was like bankable or it wasn't bankable. But now, you know, there are a lot of shades of gray, so to speak, and I think that's a good thing for everybody, really. So I actually have a lot of questions that have come in on the screen, so I'm going to try to get through as many as I can. We'll try to be quick. Paul, you mentioned this, but maybe for the other guys, is there a standard like sustainability report format or structure that you ask of your potential borrowers or existing borrowers, or is it very like kind of ad hoc? Frit, maybe you could start, or maybe you don't have one at all.
Sorry, like a sustainability report you asked?
Yeah, I mean, is there like a standard questions that you ask, or checklist, or requirements, or disclosures for before you make a loan?
No, so we don't have. I don't say there's like a standard sustainability checklist, but there are obviously, you know, probably the key ESG item for us that we always review is just thinking with older ships is like the recycling standpoint and the covenants on along environmental obligations and recycling. I think that's been a fundamental part of our approach since day one, and we've been closely attuned to Macquarie's approach, ESG approach there. And then, we are, of course, we're monitoring the what's going on with the Poseidon principles, SSI, all the other initiatives, and we support the objectives of all those platforms. But I think we, as an institution, we need to see those evolve a little bit more before we start subscribing to their methodologies and their templates. And it's all good initiative, but we're probably not quite there where we have a template where we send something to clients that might be similar to what other banks send or funds send.
Yeah. Okay. Elias?
Yeah, it's very much the same for us. No, there is no standard report, and the one thing that we always covenant for sure in our documentation is recycling, which will have to be subject to the Hong Kong Convention, et cetera, but otherwise, no.
Okay. So there's a follow-on question, which is relates to kind of scrap-based lending. Is that something that you offer? Is that a product that you offer? Lending against the scrap value of a ship.
Yeah, for sure. Generally speaking, from an underwriting criteria perspective, we are able to lend to older tonnage, depending on the segment. Obviously, that's defined differently. And yes, we very regularly lend against the scrap value of those vessels, which we consider to be end of life, if you like. So yes.
Okay. So Paul, this one maybe is for you. Oh, sorry, Frit, did you want to take that? I apologize.
No, I just say the same approach. I think for us, probably a little bit more conservative than Elias and sort of his sorts of his contemporaries in that capital group. But yeah, absolutely. Like the scrap value is a metric we use in our underwriting models, even if it's not a 15-year-old or older asset. So something we definitely look at and think is a smart thing to do. But of course, it requires responsible counterparties and transparency and everything else we've talked about.
Yeah. Okay. And I guess, Paul, this one is for you. We've heard a lot about direct lenders entering the business, and even some kind of, I would say, medium-sized commercial banks. Have you seen new entrants in the large bank world? And I guess, of course, is the capital markets activity has certainly been diminished and
Right, so apologies, you did break up there, so I didn't hear all the question, but I'll answer the first half certainly. We're not seeing really new entrants at the moment. We've seen a couple go quieter in the market, but we haven't seen new entrants to our knowledge. A few more Chinese leasing companies are coming out of the woodwork, and will continue to play a more meaningful role in the sector. But in terms of banks, I still see more shifting out of the sector or retrenching to their roots than I do new entrants. And I think that's a trend that may well continue as regulation comes in, whether that's Basel IV or other accounting standards. So not really. Unfortunately, I missed the end of your question, Matt.
Okay, no, that answers it. Elias, this one is really for you. We're seeing more LP allocation toward credit just across the board. How many direct lenders are in the business now, and do you think that will continue to grow? And is there a limit to kind of how much the industry can satisfy?
Yeah, sure. Look, definitely credit strategies have seen tremendous amount of inflow over the last few years, and private credit is probably the fastest growing sub-strategies within those. So there is no doubt that you will see more people trying to break into this business. There are, from our perspective, yes, there are probably a number, off the top of my head, I can probably name 20. If you ask us though, honestly, who do we consider to be long-term here to stay and able to deliver fast and reliable execution in size, we would probably say that they're down, you can count them on the fingers of one hand. Each one comes at it from a slightly different perspective. They have slightly different mandates, slightly different underwriting criteria. But those 3, 4, 5 people are probably here to stay, and you will probably see consolidation of the direct lending market. Also, I would note, and we went through this exercise obviously 2, 3 years ago, setting up this business to be able to deploy significant amount of capital is not necessarily quick, easy, or inexpensive. And so there are certain barriers to entry as well in terms of doing this successfully. So I hope that answers the question.
Yeah.
I just say that I think there's 2 main barriers to entry or challenges to entry for investors, new investors into this sector. First of all, shipping hasn't made consistent or persistent profitability for a decade or more. And investors will want to see some big profitability before they put their money to work, their capital to work. The second situation is we've got this energy transition. It's not going to go away. It's just going to get bigger, this subject. And investors, particularly institutional investors, are looking for sectors to invest their money into. And they don't see shipping at the moment as a green sector. Shipping cannot be a green sector overnight, but it has got a transitional opportunity through LNG, for example. And if we can embrace, as a sector, embrace LNG as a fuel, as a transitional fuel, then I think investors will invest in it, but they need the certification of LNG as a transitional fuel in order to invest their capital. But at the moment, there's big question marks led by the CBI over whether LNG is going to be seen as that transitional fuel. Because if we try to go green overnight, there actually is no investment to make. So I see that as a major barrier to entry to investors in this market, and actually will put back the energy transition.
Yeah, well, I mean, I think capital is remarkably efficient at finding good ideas and returns. I mean, you've seen it with Tesla, you've seen it with wind. I mean, there's an amazing collective knowledge among capital. So I think hopefully the same will be true of shipping. Fred, I have time for one last question. Can you guys hear me, by the way?
Yeah.
Yep.
Okay, good. I know Macquarie does a lot of business with financial sponsors, right? Providing leverage to maybe even guys like Elias, but also like private equity type of investors. How would you describe the volume of deals in that world in terms of, financial sponsor leveraging?
That has been probably one of the most significant sources of business for us at Macquarie. I don't know if I can quantify it very well, but I mean both, equity-owned joint ventures or a sale leaseback provided by, for example, Australis, and us providing leverage on that lease or leverage on a portfolio of leases that someone like Australis would have on their books. That's definitely been a large source of business for us. And it's something that I think DVB used to do in the past, and there are several other sort of middle market lenders that still do focus on this. And we love that business because on the other side we generally have institutions, rational investors, counterparties that are writing the same loan documents or similar style documents to what we're writing, and not saying that traditional owners don't respect those documents, but it's just the mindset is quite straightforward, and sometimes in the underwriting world, it's helpful to sometimes speak to the people who speak the same language day to day. So I do think that is an interesting area. Like, it's not long term, obviously. You might write a loan for 2, 3, 4 years, and then that client may disappear. So it's probably doesn't fit the approach of banks that want long-term customers. But it's been, I'd say it's been active, highly active. Obviously, we've got several new entrants, as Elias alluded to. Then also you do have, had a huge wave of private equity investing in shipping during the eco-ship sort of new building phase 2015 to 16. And there's refinancings that are required there as private equity stays in their investments and you cannot exit to come back on that note.
Yeah. Look, if I may add, anecdotally at least, when we put our first back leverage facility in place, we probably had 2 very, very strong term sheets in front of us to choose from. When we put our third back leverage facility in place more recently, we probably had 6 or 7. Okay. And that's in the space of 3 years. That's point 1. And point 2, don't forget the other big back leverage market for banks are the leasing companies. The leasing companies themselves, including the Chinese, back levered their books as well, and that has been a major source of new business for the banking market.
Well, I mean, Frit, you could back leverage Elias, and Paul, you could back leverage Frit, and Mike could do the documentation, and I want to thank you guys.
On the Chinese leasing companies, the back leveraging that they tend to do tends to be on a deal-by-deal basis. I think that's probably the difference, so that the banks lending into the Chinese, they may, of course, well be looking on the Chinese lessors as an important client, and rightly so, but they may also be looking at the underlying lessee as an important client as well, and looking at the overall structure in terms of a suitable transaction to and suitable profitability. So it does differ somewhat in the back leveraging, but I do understand that it's all good business.
Yeah, and it's certainly a collaborative market that's evolved. I mean, I think it's fair to say if a project is bankable, it will get banked. I think there was a time when that wasn't the case, but I mean, there is a place for every deal that probably should get done, which is a great service to the industry. I want to thank you guys very much. Mike, thanks for moderating. Paul, Frit, Elias, thanks for being with us. And hopefully we're gonna get together in 2021. And I wish you guys a great end of the year and a nice holiday season. Thank you very much.
Thank you very much.
Thanks, Matt.
Bye.